You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone. Welcome back to the Infinite Banking Mastery Podcast. I hope that you've had a great week. So I get a lot of questions from different clients, and one of them that I receive often is, I've received a large lump sum of cash, and I already have a banking policy or more than one banking policy. How can I put this money into my existing banking policies, or how can I grow my banking system with these funds? And so there's a few ways to go about this. The first way that I would suggest looking into to see if it's possible is to look at any existing policies that you have and then see if there's any room to fund paid-up additions. Or maybe you've had a hard time funding the full paid-up additions up until that point, or maybe it was year 5, 6, 7, or 8, and you're thinking, or you weren't going to be able to fund the paid-up additions that year, and now you're able to because you have this lump sum of cash. And so, yes, that's definitely one way to use some of that money is to fund those paid-up additions. That is definitely one of the first places that we will look is, can we fund your paid-up additions, or do we have room to add that cash? If you had skipped the year so far and you hadn't funded it at all, then of course, yes, we will. We should have room to put it in there. It really depends on your initial schedule when you started and how long we anticipated you funding the paid-up additions, because the policy is built around that oftentimes, or there's only a certain amount of time that you can fund those paid-up additions. But if you had also maybe skipped a year in the past or a couple years, then we can also look into funding paid-up additions beyond what you had planned to do, what we had scheduled to do, because sometimes you can fund more than what you started with because it's allowable by the company. But again, I want to just warn you, I wouldn't just throw that in every year, because if you have a maximum ability to fund a paid-up additions that's higher than what you were planning to fund and higher than what you started with when you started your contract, you do have to be careful, because even though the company may allow it, it could still cause your policy to mech. But if you've missed a year or two in the past, it's certainly possible. And it's something that I would want to check with the company and just review it, run numbers to see if that will be okay, just to make sure that that will not cause a mech for your policy, that it will not cause it to become taxable. A second place we could look to put that money would be, do you have any outstanding loans with your policy or policies if you have more than one? If you have an outstanding loan that you could pay off or pay down, that could possibly lower your loan repayment or eliminate it altogether. Because a good practitioner, of course, will always suggest and advise for you to set up a loan repayment to yourself. Now, there's different ways you can do that, different ways you can set up this loan repayment, whether it's a direct automatic draft from your bank to the company, whether you're sending that money in yourself, and there's different ways to do that, or whether you're sending it to your separate bank account that you may or may not have set up. So that is certainly one way to do it. You can set up a separate bank account, send the funds there, and then have them either drafted from or by the company from there, or you can send it in yourself. Whatever your schedule is, it is a good idea to have one, and we will always advise you to be treating yourself like an honest banker and be paying yourself back with interest. So paying down a large portion of any loan you have outstanding in the policy could help you pay that off much faster, pay it off completely, or pay it down and then allow the payments that you're still making to cause the loan to disappear faster, to just repay it much more quickly. Either way, you will then be able to utilize the cash again for a future investment need or other financing need that comes up in your life. Your third option would be, drumroll please, that's right, setting up more policies. Whether you're setting up another policy on yourself or more than one policy on your family members, it really just depends on the value of funds what you believe your future ability to pay premiums on this new policy or policies would be and the timing of that. Meaning, when will you be able to fund from your regular monthly cash flow, or will you ever be able to fund extra premium into a new contract from your monthly cash flow or annual cash flow? I just so happen to work out that you have paid up additions that will need to drop off of another contract at the same time you need to start funding this new contract once you've gone through that lump sum of funds. There's really a lot of ways that we could structure a policy when we have a certain amount to work with and a certain period of time that we know of, and come up with a certain period of time to be able to stretch that lump sum over. I just want to make sure it will be something that you can easily maintain and you're not going to be struggling with. So option 1 and option 3 are really the best options. Option 1, again, was funding any paid up additions possible. If you hadn't funded yet for that year, it was becoming tight for you to fund those paid up additions and make sure they're paid first, because you already have those existing contracts and we want to make sure to continue those as best we can. Option 3 is great as well, because again, you are starting new policies, adding more premium to your system. Remember that funding more in premium is how you grow your overall banking system. So adding money as paid up additions or beginning new policies altogether are both going to be adding more premium to your system, which will grow your banking system and your pool of cash throughout your life and for use in your retirement years. So these are going to be 2 of the top options that are high up on my list of priorities. However, it does matter if you have loans outstanding, if you're paying them back well, how you're doing with that. If that's looking a little rocky or you're not, I don't think funding as much as you could be, then I probably would suggest you replenish some of that money into loans so that you don't have giant loans growing where you're not able to maintain paying yourself back like an honest banker. Because paying yourself back is very important, and it allows you to replenish the funds that you've taken or borrowed against the policy and allow you to have that flexibility and that control over that cash and the money that you borrow. It allows you to pay for things or invest in the most efficient way possible while maintaining the earning power of those dollars until the day you die. So paying yourself back is great because it's going to allow you to recycle your funds over and over and use them for different things and be in control of those funds. But to grow your banking system, it's going to be through premium dollars. I will just mention one more option as well. If you were to receive a lump sum, whether from an inheritance, a large bonus from work, a tax return, selling a property or something, if you receive a large lump sum of cash and you're wondering what to do with it, another option would be to start a whole life policy with just one premium payment. Single premium whole life policies used to be very, very popular back in the day when large business owners and very affluent people would purchase these policies because of the tax benefits. It was able to grow tax-free. They were able to access it tax-free. It was going to provide an even larger tax-free death benefit. So much of that was going on that the government said, whoa, no more of that. I think we're going to put a stop to that. And that's when they created the MEC ceiling. So it is still an option, but it is going to MEC. So you could create a policy where you only have one premium, one time, and there's many different ways to build that, and we can build it in an efficient manner. It just will be too much money into a contract at one time, especially with no more ongoing premium payments. And so it will be a MEC contract. It will be taxable. It will grow pretty efficient, and cash will grow well, and all of that will be good. It will just be taxable. So that, I would say, is a good fit from time to time for certain people, depending on their wishes, their goals, their financial picture. Not for everyone. Our goal always is to keep things tax-free, for sure. That's a big part of this, a big bonus, a big benefit of the infinite banking concept is to keep the funds accessible and growing through a whole life policy so that they're growing income tax-free and so that we can access them income tax-free. But I just wanted to list it out there as an option. Well, that's all I have for you today. As always, if you'd like to work together and ask more questions on this topic, or you simply want to get started, please reach out to me at Valerie@alphaomegawealth.com. Thank you for listening and have a great week.
This is the podcastfactory.com.